AT&T is down 20% year to date. It's a very active stock on YouTube and in our community for discussion. There's a lot of attractiveness here because of its high dividend. So guys, in this video, we're going to go over some bull and bear cases from our community members. We're going to go over some the 8 pillars, obviously the famous 8 pillars we have, some high-level metrics of the company, some analyst estimates, and then finally, we're going to use our stock analyzer tool to determine what price to pay for AT&T, not including their balance sheet. Now, guys, in this video, whether you're a beginning investor or an advanced investor, there's something in this for everybody. So watch the entire video, either learn something new or repeat the things you've already learned that need to be repeated over and over in your head. Let's check out AT&T. This stock is below. When was the last time it was this low? Back in 2015, AT&T stock was this low. Guys, it does $104 billion market cap. If you want to buy every share outstanding on the market, you have to pay $104 billion. Here's the scary part to me. The first thing I don't like, enterprise value is $385 billion. That difference is the debt on the company. There's a lot of debt on this company, a ton of debt, a ton of debt. Now, some positives for the company. In the last 12 months, they've reported a loss of $9 billion almost, but their cash flow was $18 billion. Mm-hmm. Their 5-year average net income is $7.7 billion, but their average of the last 5 years is $23.5 billion of free cash flow. So this tells me, based on the 1-year number, that there was some sort of write-off in here that affected this net income number that did not affect cash flow. All right, so that's a positive, right, Mo? Mm-hmm. All right, now, 59% gross margin. That's awesome. That means for every extra dollar they sell, 59% of it, 59 cents of it goes to the bottom line to pay taxes and their overhead. That's what's great here. So if they can increase their sales at this clip with this high gross margin, they can really increase their overall margin of the company, which has been suffering the last 5 years. All right. Now, everybody probably is attracted to the 7.8% dividend yield. Everyone. And they can afford it right now because last year's free cash flow was 18.2 and their 7.8% dividend only paid out $8 billion. So they can easily afford that dividend.
Yep, for sure.
Easily. But I still have the concern about that debt.
Yeah.
So Mo, I'm really interested to hear what people in our community are saying about their bull and bear cases for AT&T. So let's pull it up right here. I'm pulling it up in our community chat right here. All right. So go ahead.
Let's see here.
Well, first one, bear case. This is the first stock I saw an evaluation by EM. My investment process changed to the better and been in the community since membership started. EM to the, what is EMOG? Original Gangster?
Original, yeah.
All right. Thank you very much, Rich. We appreciate that. I don't know how that's a bear case, but I appreciate that. All right, guys.
They control 46.6% of the wireless subscription market. It's according to our analyst, Dalton.
Here's what I like what Eric said. Look what Eric wrote.
Okay.
To be honest, I've never cared to look into AT&T. This is the beautiful part about having a process. You can take a quick look at the EM 8 pillars and see a story. For me, this shows either it's a bad business or a poorly run business. Wow. Look at that. So he just says, you know what? I can spend my time doing something else.
I totally agree.
And I totally agree with that for a lot of things. So Wicked Willie is Dalton, our analyst, and he has a couple bull cases and bear cases. Mo, why don't you go through them?
So they launched AT&T Internet Air Plug and Play. They can be installed in 15 minutes. What the hell is this? Let's see. And let's see what Air Plug and Play is.
Wow, and they control 46.6% of the wireless subscription market.
Yeah, it's a big number. Oh, okay. So it's like this Wi-Fi extender.
Okay.
Cool.
Is that the AT&T is looking to offer fixed wireless access to 4 million customers?
Yeah, at a price of $35. Yeah, that's
okay.
This thing. Yep.
All right, 2 bear cases. Yeah, terrible capital allocation.
Terrible. And it's not getting better.
I agree with Dalton when he says this. They should be paying off their debt versus paying a large dividend. I agree completely. The debt to me in this company is what could be the problem for the company. Now, Mo, keep looking at the bull and bear cases. I want to pull something up about the debt numbers.
Okay. Rich said, I believe this is an industry push. AT&T believes the copper assets tagged for the retirement carry costs of $6 billion annually. Copper solutions are aging. What is it? I have read a lot about this copper. Now, let me go to this story here. Does this have to do with their lead cable stuff? Or am I mixing up my metals? Let's see.
So one of the things I want to look at, Mo, is what their interest costs are on that debt. And in the 10K, they're going to have something written here about their interest costs and what the let's see, the balance sheet. Long-term liabilities.
So the company currently services 60 million locations with copper versus 16 million with fiber, aiming to get that number down 50% with a move to fiber, expecting to be around $6 billion. Okay. This whole fiber stuff needs to start happening faster.
The fiber stuff?
Yeah.
Okay,
See,
interesting.
The AT&T is in a little bit more trouble. There was an alleged public health risk for the lead cables that they were using. They say they're not a problem, but they're going to be switching them anyways. And I remember that number was huge. Was it like six?
Man, it's just such a tough. Mo, look at their revenue. I mean, the revenue growth has been nowhere. Yeah, they've sold off division, they split things off, but I just look at this going, poop. Big time write-off, $26.8 billion last year, which is giving them, I mean, listen, their cash flow is great. But again, look at their debt levels. That's what I have a concern about.
Bear case here from Nate. Their massive $160 billion net debt will have to be refinanced at a much higher interest rate now that rates are on the rise. I'm avoiding.
So let's talk about that.
Companies.
So look at this. This is their 10K here, right, guys? The weighted average interest rate of our long-term debt portfolio. What they're doing is they're taking their entire debt portfolio, adding up all the interest they pay, and dividing by the total. It shows the average weighted cost was approximately 4.1% at the end of 2022, 3.8% at the end of 2021. So as these debts start to be refinanced, whether they took 3, 5, 10, whatever number debt they took in terms of years, that rate's going to go up. So on $170 billion, if the rate goes up by 3% on average, it's $5 billion extra per year in interest costs. Because we've seen how much rates have gone up in the last year. And these have not been refinanced in a while. So that is a concern I have. Can they still afford it? Well, yeah, they keep maintaining their $18 billion free cash flow and growing it. They can afford that increase. But guys, that debt level is so freaking huge. A great company can go bad because of debt levels. And that's what I'm worried about here. That's what I'm very much worried about here. What else you got, Mo?
Pretty much everybody's talking about the debt and saying I'm out. Like D-Money here, their debt is massive. I'm not confident they could pay off their debt and afford the dividend. For me, it's too risky. I'm not interested in this.
So then the question becomes to me of one thing. If they're all negative on it, is that the entire market being negative on it? Is it an opportunity?
Yeah. I mean, maybe, but it's the problem with AT&T for me is they've proven that they're terrible capital allocators for probably a decade plus at this point, and it's not getting better.
So if they cut their dividend, they would save that 7.7% and they could pay down debt.
If they did that, the stock would crash. But I would think to myself, okay, they actually got smart. Maybe now is the time that they're starting to take this seriously.
And maybe they should buy back shares instead.
Just do something besides pay a dividend to your great
Let's go to the 8 pillars here.
Really want this.
Remember, guys, if you remember our community, you can customize your 8 pillars up to 12 different pillars.
Literally the opposite of what I want to see.
I mean, guys, price to free cash flow is 4.5. PE is 13.5 on the 5-year number. Now, the 5-year number did include I think the previous the companies they spun off. Everything here is just a mess. I mean, look at this debt, 10 times their 5-year average free cash flow. And again, I think that for a 5-year free cash flow is, look at their 5-year free cash flow, down $10.7 billion. This is a tough one. This is a really tough one. Let's see what analysts are saying. Oh, wow. Not much growth here for earnings per share. $2.46 per share this year, going to $2.67 in 4 years. But again, it's a cheap company.
Yeah.
$14 a share.
Actually, okay, never mind.
Look at their revenue growth. It's just shit.
Yeah, it's nothing.
Guys, I think to me, in order to buy into AT&T, you have to really have a proper understanding of their debt and their covenants of their debt. What could trigger them to be completely call out their debt? Here's what I would say, and this is not meant to say I'm right. If you told me in 10 years AT&T was out of business because they default on their debt, I wouldn't be shocked.
No.
I'd be Like, oh, wow, really? But I wouldn't be like, oh, this debt level is so high. There's only so much debt a company, almost that a country can have.
I don't think I would. True.
Yeah.
I don't think I would say, oh, really? I think I would be like, it was only a matter of time.
Yeah. Well, no, I disagree with that one. I'd still say,
Really?
oh, really?
Mm.
I don't think it's a matter of time. If they go back there and start being smart about their balance sheet and say, listen, we're going to do this balance. We need to focus on this balance sheet because that's our biggest issue. Awesome.
Haven't and so I don't know how long.
This to me tells me that the company heads are more worried about the stock price than anything else.
Yeah, for sure.
And you might sit there and say, well, they should be. No, they shouldn't be. They should be worried about doing the right thing. And if they do the right thing, that'll increase the stock price. All right, guys. So it leads to our final thing, Stock Analyzer Tool. What price should we pay for AT&T stock? Now remember, the issue with Stock Analyzer Tool here is it doesn't include the balance sheet. This is purely based on a cash flowing business. So my guess is we're going to see it to be a major buy, but let's go run through it. And remember, if you're interested in learning about the community, click the link above. Very quick video about our community and how you can become a better investor because of it. So when was the last time I did AT&T? AT&T. July 18th.
Okay.
I did a 10-year analysis. Oh, interesting. Interesting. Mo, did you do it back then?
What was the date?
July 18th.
Let's see. T.
No, type in AT&T. That'll be helpful. Oh, you did it
August 16th.
Oh, pull it up.
Let me pull it up. Okay, I was going to be more bearish.
Okay. So I did a 10-year analysis, and the first line of it is my revenue growth number. Now, guys, look at this. Their ROIC is so low. This means they're bad at getting return on the money invested in the business. One of the positives is them paying a large dividend. They're saying, listen, the money's better off in your hands. This is actually a place where I go, if the ROIC is so high, don't make acquisitions. Could this be like GE back in 2000? I don't know. All right, guys, revenue growth. I did -2 on the low side, keeping it even and growing 2% on the high side for the next 10 years. Mo, what'd you do?
I did revenue growth, -1.5, 0, and 1.5.
Okay. Profit margin. I did 5, 7, and 9% because I looked at their 10-year. That included this -7 in the last year. So I thought to myself, hey, maybe they can get the 9. So I did 5, 7, and 9. Mo, what about you?
I did 3.5, 5.5, 7.5.
Okay. Really low.
Yeah, it's really low.
Free cash flow, significantly higher than their profit, but I still dropped it. I did 8, 10, and 12.
Oh, I did 11.5, 13.5, 15.
Yeah, I went very conservative here. I really did. I don't know why.
Okay.
But I did. All right, now PE and price of free cash flow. What earnings multiple and what free cash flow multiple do you think the company will sell for in 10 years? Now, I did 12, 14, and 16. I think I got to change that. I think I'm going to go 9, 12, and 15. And only 15 if they really turn things around, make it a growing business again, and really get a handle that balance sheet, which I think would take a lot of different things, including positive results for them as a company. So I really do think this is a very low likelihood. Mo, what'd you do?
I did 10, 12, and 14 for
Okay.
both.
Okay. Now for final thing, your desired annual return. Guys, this is what matters the most in terms of your margin of safety. You can get 9 or 10% from investing in a long-term ETF. The higher your assumptions are, the more margin of safety you need. Mo, I'm going to do something crazy here. I did 12.5, 15, 17.5. I'm going to change that. I'm going to go to 14, 17, and 20% because, guys, I hate this balance sheet. To me, I need a lot of potential return for me to be interested in this company. So I did 14, 17, and 20%. Mo, what are you doing?
I did 13, 16, and 19.
All right. So, guys, I'm going to hit the analyze button. I want you guys to remember a couple of things first. One, this is not factor in the balance sheet. If you're scared of the balance sheet, I think you should avoid the company. This 14, 17, and 20% is really going to drive the price down really low on where we need to be. But it's basically saying, this is the return I need for me to be interested in this company. It needs to be like a huge return potential, which could be there. I don't know. Just follow along for 1 or 2 more minutes. We're going to sit here, go through the numbers. We're here to teach a process, and that process will be explained further as we explain the numbers. I'm going to hit the analyze button. Wow. Low price of $550 to $885, high price of $11.12 to $14.83, middle price of $8 to $12. Now, guys, if you paid today's price, low assumptions occur, you're going to make 5.38%. Middle assumptions occur 13%. High assumptions occur 20%. Mo, what'd you get?
I have 435 to 1430 on the low.
Whoa.
9 to 19 on the high.
Yep.
And about 7 to 17 in the middle.
Okay, so guys, this is a tough one. I really encourage our community members to really engage on this one because there could be opportunity here because of what a big sell-off it's been and everybody's so negative about that debt. Thank you very much for your time.